they're two completely different accounts, if you haven't figured that out. But all of these accounts and their balances then becomes the fulfillment of all my assets are equal to all of my liabilities and equity accounts. And these balances are in the general ledger. So that's your one book in your accounting system. I kind of like to call it the second book, because we get to the general ledger because we have entered from the general journal. But your book approaches it a little bit differently. They introduced you to the general ledger first, and now they're kind of backtracking in chapter 4 to a general journal. So this is, again, your general journal is activity. And activity meaning the day-to-day financial transactions of the business, what's happening, what day did it happen on, what accounts were affected, how much money was affected, that type of thing. And then all the activity gets updated into the general ledger. So just to kind of give you a very simple little picture here of a general journal. A journal, if you've ever kept a diary or a journal, this is really nothing more than a book of events. And we call it general in this class because that's as far as we're going to get, but there are all kinds of different journals that some companies keep manually. No one, I don't want to say no one, because there's always an exception to that rule, but the majority of companies these days has computerized accounting systems. But there are still some companies that, some mom and pop shops that still use some general journals on paper, but they may have some other type of journals. General just meaning all kinds of different transactions can go in here. And a general journal is capable of taking care of every single transaction that would happen in our business. Okay? So a general journal kind of reflects those rules of debits and credits, and that we're going to have basically this many columns. We've got a date column. We've got an account description column. We've got a post-referencing column that we'll talk about just briefly. And then we have a debit column and a credit column. Because for every one transaction, what happens? How many accounts are affected?
At least one.
At least two.
Oh, right.
Okay? For every one transaction, we have at least two accounts affected, because at least one account gets debited and at least one account gets credited. Okay? And that's just the way it has to be, because at all times, debits have to equal credit. So a general journal takes a transaction and identifies the accounts affected, the date that it happened, potentially any other description that we want to keep about it, and then a debit or credit column to indicate this particular account was debited, this particular account was credited. So let's go to that, we'll say it's January the 1st, and Jane is starting her cab business. We've been talking about her for a while now. And going back to that very first entry that all businesses have, when they put money into a business checking account, we need to establish some kind of way to keep track of the balance of that cash account. So we, of course, create a T or a ledger account here in a second for cash. But when Jane moved money from her personal account that maybe she'd been saving for many years into a business checking account, she was contributing capital. That's how we express that phrase. And capital just meaning owner's equity. Those two words, never forget that anyone's capital and their owner's equity is basically the very same thing. They're just different words. You know, who knows why we have different words, except that if you were to go on in accounting, you'll learn why. But in this class, just know that owner's equity and capital are completely the same thing, the same account. So the first thing that happened when Jane put money into her business account was her cash went up. So in a general journal, the first thing we want to describe is what account was debited, and we see here that the first account affected was cash. And you can pull up blank general journal forms on Google and print print some off if you wanna look at them, but essentially, again, it's nothing more than columns separating what we're trying to keep track of. And so the first thing we wanna keep track of is what account was affected, cash. And let's say that she put $5,000 into her business account. So her cash went up, didn't it? The cash in her business checking account went up. And the rule for cash, because cash is an asset, assets go up with debits. If you don't understand those rules, then you're either going to have to just simply memorize them and follow the rule, or eventually maybe it will click as to what's happening. So I'm going to put $5,000 here into the debit column, indicating that on January 1st, cash was affected with a debit. Therefore, I know as an accountant that meant that cash went up when I put it in the debit column. And we just said that she did it because she was investing in her business, which in this class we will describe as owner's equity. Therefore, my next account affected is owner's equity, that I abbreviate in here as OE. And owner's equity goes up on the credit side. Therefore, it did just go up when she put money into her own business. Therefore, I'll record $5,000 in the credit column for owner's equity. So both of these events created an increase in these two accounts. Cash went up and owner's equity went up, but they go up with different sides of the coin, so to speak. Okay? So again, if you're still struggling with your rules of debits and credits, it really is a matter of practicing and doing it over and over and over again and memorizing those rules. Because here's the problem, and I'm only going to discuss this one time in the course because it gets too confusing for most people. But I do want you to understand why some of you may be struggling, and maybe this will give you a way out of struggling specifically with the cash account. When you go to the bank and you make a deposit, and I'm talking about just you and I on an everyday basis, if you happen to still go by the bank and give them money through the teller machine or go inside and hand money to a teller, and you say that I want to make a deposit into my account, and you give them, some cash, and they deposit to your account and they hand a receipt back to you, that receipt is going to indicate, of course, the amount that you put in, the account number, and then it's going to have, most of the time these days, it still has a little description, we have credited your account. And so all of you are thinking, well, you just told me that if I record an increase in cash, it goes up with the debit. So you have got to release the things that the bank is doing, because the bank is reporting on their books, not yours. They are not keeping your records. I mean, they're keeping track of how much money you've got in the bank, but they have an accounting system just like we have an accounting system. And if you just gave them $500 in cash, and they put it in their little drawer, the teller did, at the end of the day, that cash in the drawer goes to a vault. Okay? So the bank definitely has assets, they have liabilities, and then they have equity as well. It's a little bit differently, we're not going to get into that. But they've got all kinds of assets. They've got buildings, they've got equipment, they've got vehicles, some of them, they've got all kinds of different things. But one of their biggest assets they have on a day-to-day basis is money in the vault. Physical cash in the vault. Whose cash is that?
Everyone's.
Potentially. But primarily, if you are going into that vault, the big little handle on the vault, there's a whole bunch of cash behind that vault door. And the bank has got to keep track of it. Remember, this is only about keeping track of things. Assets, liabilities, equities. Well, the bank has got to keep track of those dollars behind the vault wall. So that cash is an asset to them. What is different, though, is that that cash is owed to, and I don't mean that physical cash, that cash potentially is owed to different people. And so when the when the bank takes your deposit, and we're going to say that this is a bank journal entry, this is what happens. and this is just a very messy little journal here. Okay, so it's January the 1st, and Jane just went to the bank, and we're not looking at Jane anymore, we're looking at the bank. The bank records it as it was an event on January the 1st, and they had cash involved, didn't they? Jane gave them $500 in cash. They're gonna go and put it in the vault eventually, by the end of the day. Do they not need to increase their cash account in the vault to $500? Cash in vault just went up, $500. It is an asset, it goes up with a debit. But the key here is, what is the other side of their transaction? Because they didn't earn the money, so it's not a revenue to them. Right? They didn't get that cash because they got rid of another asset. In other words, Jane didn't come to the window, the teller window, and she gave them $500, and then they, in exchange, gave her, I don't know, a prepaid debit card or something. It's hard to visualize what could happen. But in other words, they didn't release another asset in exchange for that $500. But they do need to keep track of the fact that that was Jane's money. So Jane is a liability to the bank. Everybody see that? So they're going to credit Jane's account number, and we'll just say she's 101 in the bank. $500. This right here is a liability. Liabilities go up on the credit side. That's why they're not telling you, when they give you that receipt, they're not telling you that cash was credited. They're telling you your account was credited. Your account payable, so to speak. Your account with them has been increased to reflect the fact that you have now $500 more in their bank than you did yesterday. So there is a reason why the bank is crediting your account, but they're not crediting a cash account. Okay? So I'm only introducing this because the majority of you, it's probably already gone over your head and you're not quite getting it. But what I'm saying is that the bank is keeping books just as well as we are at all times. And so in this class, we are not keeping track of the bank's records. We are keeping track of our records. Okay? So quit trying to, because I know this is going on with some of you, don't try to associate the bank terminology that they send back and forth to you with using a debit card or using a credit card or anything of that nature. We have got to stick with debits and credits as they relate to our bookkeeping, not the bank, not the credit card, not anybody but us. Okay? And we have to identify what our assets are, what our liabilities are, and then, of course, what our revenues, expenses are, et cetera, and follow the rules. Because if you don't follow the rules, you will struggle the entire time in this course. Okay? Again, this is a process, and the process that we're dealing with at this very moment is Jane Doe's books, not ABC Bank's books. Okay? Because everybody's got a set of books. There's not a company in this world that in some form or fashion does not have some kind of accounting records. They may be very, very simplified, but every business has to have some kind of accounting, where things are coming from, where they're going to. Okay? So that's just kind of a brief, and I don't want to spend any time on the bank's issues because we are not doing bank records. But you've got to get out of your head anything that you associate as being up, down, positive, negative, good or bad with the phrase debits and credits, because they don't mean anything. What do they mean in this class?
Left
They
and
mean
right.
left and right. Because look, the way I've got my journal set up, debit is still left and credit is still right. That didn't change, did it? And you'll notice in a formal journal entry, and there's nothing formal about this really, that just, I'm such a diehard accountant that I cannot write a credit account, the account that's fixing to be credited in a journal, without indenting it. And I'm indenting for one reason. That's because, first of all, I was taught to indent, but because the general rules of accounting, when manual books were created was it was all visual. Accountants are very visual people. And it's visual when it has to do with left and right. It has nothing to do with that we can visually see cash on the desk or we can see cash in the vault. It has to do with the visualness of the left and right. Because it's like, I don't know, it's just like a second nature thing that you get into once you've done this many a time, that you're always looking for left and right. And so that visual indentation indicates I'm fixing to do what to owner's equity. What do you think? I mean, it's obvious, but when I write owner's equity and I slightly indent it, the reader of that journal knows that I am about to credit that account. That's right. Because I'm slightly indenting to the right. Debits are listed flush left, and as you see my little arrow there, credits should be slightly indented to the right. Again, accounting is full of visuals throughout everything that we do. Okay? And that's the only reason. If you want to make everything flush left, and I can't remember in your homework if it does it or not, does that really change anything? No. What changes? What changes the composition of this journal entry? What do you think? Right here, isn't it? It's where I record the dollar figure. Did I put it on the left side, or did I record it on the credit side? So that's telling me what I'm going to do, because from this journal then, which brings us to the general ledger, and I shouldn't have drawn the lines all the way down, because this is a whole different book called the general ledger. The ledger is nothing more than a bound book of pages with every page indicating what account is tracking on that page, whether it be cash, owner's equity, rent expense, accounts payable, accounts receivable, and then all of those pages bound together becomes a general ledger, and all the pages in that general ledger at all times, debits should equal credits. And then, of course, you can see in the journal we are also entering in equal debits and credits. So it should flow down to the general ledger appropriately as well. So we use the phrase, we enter into a journal. And it's just an accounting thing, but it is very specific. I guarantee you that if you can learn the language of accounting, you're going to do much better too. So we enter into the journal, and we post into the ledger. So we have entered a $5,000 debit to cash, and we have credited owner's equity for $5,000. But I want you to kind of visualize this page of the journal. Let's say that we had, 500 more transactions for the month of January. Entering a debit to cash, potentially a credit to cash here and there. All these different transactions that happened. We've got a whole page after page after page of transactions that happened, and we recorded them or entered them by date, chronological order, with the accounts affected and the amounts affected. But let's say that this was, January 1st was the third year that she'd been in business, and she just happened today to add an extra $5,000 to her business that she'd been saving. Can I look at that general journal? And again, I realize it's very sloppy, but can I look at that general journal right there, and if she had been in business the previous 3 years, do I know how much cash she's got today, January 1st, by looking at that? No. This just tells me on January 1st, this is what happened to cash. It went up $5,000. Everybody agree with that? But if she's had transactions prior to January 1st, or between January 1st and January 31st, if I want a balance of cash, I've got to take every individual transaction and post them to the ledger. In other words, update my general ledger account balance. So I will take every transaction, out of the general journal and post it exactly as it just told me. It said go to cash and debit $5,000. So I went to cash and I put $5,000 on the debit side. I enter a little check mark here in this PR column, which stands for post-referencing, meaning that I have posted it, and referencing that with that check mark indicates that I don't want to lose my place, so to speak. Because again, you can have 500 transactions in 1 month, easily. How many times, let me finish this one. So the next part of this transaction, though, was to go to owner's equity and put $5,000 on the credit side. Put my little check mark, I have posted the credit side of this transaction. So at the end of the month, I would make sure that I have posted everything accurately. And this is where mistakes most of the time happen. Failure to post correctly into the general ledger. But at the end of a round of posting, we check not only did we enter into the journal equal debits and credits, did we post equal debits and credits. Now you can see why computers, it's my personal opinion, that the first IBM machine that was International Business Machine that was developed was definitely for business purposes. And my guess is, and I haven't done any deep research on this, so don't hold me to it, but my guess it was accounting, because it's so easily programmable. If you tell the computer that if I put 5,000 in the general journal, I need you then to move it to the general ledger to update the account. Updating the account is just as important, or maybe even more important, than entering it into the journal. But you can't do one without the other in a manual system. Okay? So, again, this process is entering into the journal, posting to a ledger, and you can see where a computer can be programmed to do exactly what I put it in here in the journal. A computer can be programmed very easily to update the account balances. Because remember, after 500 transactions, how many postings will I make into the ledger? How many times will I physically move things?
Times 4.
Times 2. 500 transactions, 1,000 different entries minimum will be made. And if there were more than one account, or more than 2 accounts affected in a particular transaction, it could be more. But a minimum of 1,000 times do I have to go to different accounts and reflect what I entered from the journal. Computers made that seamless and error-free. And you see that the potential of humans making these errors are tremendous. Post it to the wrong account, put it on the wrong side, add it incorrectly. Accounting is full of checks and balances, and a computer makes those checks and balances really quickly to identify. Well, your debits don't equal your credits. You've done something wrong. And it's probably because you entered it incorrectly in the journal, because the computer is going to do exactly what you tell it to right here. But we're not doing computerized accounting, but the point is that you see a journal is nothing more than the outlying effect of a transaction. What accounts are affected, this is where we're identifying them, the date, possibly a description, all of those things that you want to remember about a transaction are put into the journal. But a ledger keeps track of nothing more than the dollar balances that were involved after all the transactions got moved over to the updated account balances. So that's just kind of an introduction of going into Chapter 4. But before we get to that, I do want to, at the end of Chapter 3, just reflect what we're ultimately trying to do with all of our accounting systems. Let's see if I can find it. Yeah. If you have your book in front of you, or can find this quickly online, you might be able to see it just a little bit better. But this was for Mitchell's Campus Delivery, and it was a problem that had been going on throughout the entire chapter, Chapter 3, different transactions. And at the end of a round of transactions, this was for June the 30th for Mitchell, these were his account balances. After entering into the journal and posting to the ledger accounts, Mitchell had cash, accounts receivable, supplies, prepaid insurance, et cetera, all the way down to wage expense. And these were the balances in those accounts after Mitchell entered into the accounts from the T accounts after his balances were computed, put it in balance. So he had, of course, you can see $470 in cash, all these things, and so he's done for the month of June as far as posting, etc., and he knows that he has entered equal debits and credits into his accounting system. And now the trial balance, it's the proof, of course, again, that we have entered into our system correctly. But now he wants to make better sense of, well, did I make money? Did I lose money? Has my equity gone up or down after a month of business? What do I have? And so most business owners are not accountants. And I can tell you from working with business owners for the last X amount of years that the majority of them, unfortunately, are kind of clueless in that respect. But that's why they hire me. You know, you don't know what, you know your part of the business, and I know my part of the business. And don't do what you don't understand, right? In other words, don't get involved in an aspect of your business that you're not sure what you're doing, because what's going to happen? I mean, you're probably going to have all kinds of errors. You could potentially file a tax return that's not correct. I mean, all kinds of things can happen. So I have an agreement with my clients, and we laugh about it all the time, all of us, that we are friends because we both do different things. You know, I'm an accountant, you may be an engineer, but together we can make an engineering business be not necessarily profitable. That comes a lot more on the engineer part, but I can help you stay in compliance with all the laws and all the tax requirements, and knowing if you're making money or losing money, because most engineers this is not their thing. Most doctors are the worst. They're really good at what they do, you know, the majority of them, but the majority are not good business people. Now, there's always an exception to every rule, but and we talked about that the first day. People think differently. Doctors think very, I don't know, scientifically, I guess you could say. There's not a scientific bone in my body. You know, it's black and white. It either happened or it didn't. But they can visualize, you know, what might happen if you do this, or, you know, what's going to happen if I intertwine these two drugs, etc. So if you're following me, you understand that we all have our different strengths and weaknesses, and this is why then on the next page, I hand to my doctors at the end of a quarter or a year, and I show them, this is what happened in your business this year. Because what are they busy doing? Or what should they be busy doing?
Taking care of people.
Yeah, taking care of people. Why would they waste their time keeping records that they struggle to, you know, even understand what's going on? It just doesn't make sense. And so financial statements are what we provide the business owners, or potentially a lender, or the government, etc., in that my doctors understand these kinds of statements that I hand to them, but they don't have a clue about debits and credits and the T accounts and the general journal and, you know, how it got into QuickBooks and how it spit this out, et cetera, et cetera. And they don't care. They've got more important things to worry about. So our job as an accountant is to take that information and put it into usable formatting that does make sense to them. Does this make sense to you, what happened with Mitchell's campus delivery at the top of page 68, if you do have a physical book with you? But this is figure 323 in your chapter, if you have it pulled up on your screen. But this was Mitchell's income statement, and it says that, Mitchell's campus delivery income statement. So first of all, you got to know the words behind the financial statements. Income statement is exactly what it sounds like, or hopefully it sounds like to you. It's a statement of income. Income meaning, where did Mitchell earn the money, and how much did Mitchell spend making the money? Those are the only two things that will ever show up on an income statement: revenues and expenses. You're not going to see his assets. You're not going to see his liabilities. You're not going to see anything except how much did Mitchell earn, how much did Mitchell spend in a delivery business. Okay? So it should be pretty easy for Mitchell to see, okay, this is your delivery fees for the month ended June 30th. And it's kind of hard to see there with these colors I put on there, but it says $8,000. So Mitchell, looks like to me, kind of had a nice month earning $8,000 in fees. Agreed? We can make that assumption. We don't know for sure. But assuming this was his first month of business, I'd say he had some nice clients and customers in line. Okay? So we can also determine that Mitchell had some expenses. He paid some wages, some rent, and a phone expense. So he spent $1,600 in wages, well, $1,650 in wages, $1,000 in rent, and $100 in phone. He spent $2,750 in total expenses. So his net income, and net in math, net in accounting, net in any business language means the difference between two things. So his revenues were $8,000, he spent $2,750 in expenses. His net was the difference between the two, or $5,250. It's what he netted in excess revenues over expenses for the month of June. The heading is very important, because what if that had said for the year ending June 30th? $5,250 for a month, for your first month in business, in my opinion, would be great. Because I've had many clients over the years that it takes them a couple of years to turn a profit at all, to make money. He did this in 1 month. But what if I changed that to for the year ended June 30th? He still made money, didn't he? $5,250. But how many of you in here can live for a whole year on $5,250? Not anybody that I know. But for a month, you could do it. So the heading is very important. It's the who, what, and when. What are we telling Mitchell? We're saying this is for your business. We're saying this is for your income statement for the month ended June 30th. And he's relying on the fact that he has some understanding of the heading of a financial statement, but he knows that he had a good month. Okay? Well, what kind of accounts are revenues and expenses? What did we talk about last week? They are, in our fundamental accounting equation, assets equal liabilities plus owner's equity. And remember, those are the only three accounts we have, really, elements of accounts.
They're debit.
No, I don't mean debit or credit. I mean, what in the fundamental accounting equation, what are revenues and expenses?
Owner's equity.
Yes. And they're temporary owner's equity, aren't they? So we need to bring together all of Mitchell's owner's equity into one spot, and we call that the statement of owner's equity, which is the second. And we go in a very specific order. Step 1 is always to complete his income statement. Step 2 will be to recap now all of his owner's equity into one spot. So he didn't have anything at the beginning of this month because he started his business this month. He added $5,000, remember, from, well, we didn't go over this problem, but if you went through the problem in the book, and really the book does a pretty good job of giving you some great examples. I would highly encourage you, if you're not reading, you've got to read. It's going to help you a lot. He invested during the month $5,000, so his net investment or total investment was $5,000 for June. His net income for the period was $5,250. Where did that come from? See the big red arrow? It came from the income statement. So you can't do the statement of owner's equity until you have done the first one, which was the statement of income, or income statement. He also had withdrawals, and all of this is coming from the previous page, all of these balances from the trial balance. That's where financial statements are prepared from. They are prepared from the balances that we come up with after a month or quarter or year of calculating and recording transactions. We are going to use the balances in the trial balance on this specific financial statements, and they're all going to come together like a big puzzle at the end. Part of the puzzle we've already completed. Again, we did the income statement number 1, gave us our net income. We took that figure and then completed the statement of owner's equity, which takes our permanent owner's equity account. We subtract our withdrawals. We add or subtract net income or net loss. As you see here, net income was $52.50, and on the trial balance on the previous page, he had taken out $3,000 for the month of June. So his increase in capital was really only $22.50 after he withdrew $3,000. So at the end of June, Mitchell had $7,250 in owner's equity. That was what he contributed for the month, but he earned for the month less what he took out for the month. And so you could tell Mitchell, well, your worth today is $7,250. Now, what is the question going to be? What do I own that's worth $7,250, right? So a balance sheet is the final financial statement that we prepare, and it is, as you see my little designation here, it is the recap, do assets equal liabilities plus owner's equity? And this is in, it's like my ultimate last piece of the puzzle. Is it going to fit? Because assets have to be equal to liabilities, owner's equity. But what does this look like to y'all? This balance sheet presentation, if you were just to break it down into an overall picture, what is evident about that particular formatting? What I tell you about, accounting is very visual. So what do you see there on that report? Real basic. I mean, you see a heading, right? Who, what, and when. Mitchell, this is his balance sheet. That's what we call the fundamental accounting equation. And for a specific day and time on June 30th, this is what you owned in assets, this is what you owed, and this is your owner's equity. But how is it formatted below the heading?
Assets are on the left.
That's right. Assets are on the left. And what's on the right?
Liabilities.
Liabilities and owner's equity. Does that not fit the fundamental equation and our keys that we set up? So again, accounting is full, either intentional, I'm sure it was intentional, or just coincidentally, it just all works out that way. Because I could flip those, couldn't I? I could put liabilities and owner's equity on this side of the balance sheet, because this is just a report. But it would be, for an accountant, it would be like running your fingernails down a chalkboard. Why would you do that? Assets are always on the left. But does it really matter? I mean, in real life, would it matter if I switched them on this piece of paper? No. But again, accounting is, very much a left and right scenario. So on the left, from the trial balance, we picked out every account that was an asset. He had cash, accounts receivable, supplies, prepaid insurance, and delivery equipment. Only on this particular financial statement, only assets are listed as assets. Well, that sounds like a very redundant and paradoxical statement, doesn't it? Because assets are assets. What did you have to be aware of, though? If you were looking at this trial balance over here where all these account balances came from, you had to be able to distinguish, didn't you, between what was an asset, what was a liability, what was a revenue, what was an expense, because on the balance sheet, you only see assets on the left. And there were a lot more than assets on that trial balance. So this is where you're going to figure out, again, did you do it correctly? On the right, we list, of course, any liabilities that we have, and he had one liability, accounts payable, for $1,500, $1,900. And then where did the Mitchell-Williams capital figure or owner's equity, where did that come from? You see the big red arrow? It came from statement number 2, didn't it? So we plug in that number, and what is the $1,900 plus $7,250 is $9,150. My assets conveniently totaled $9,150 as well. That's how we know that now Mitchell had a totally imbalanced system, starting from entering into a journal, posting it to the ledger, and then creating a trial balance to make sure everything was in balance, and now again putting them in a readable form for Mitchell, because now Mitchell can see, oh, okay, this is everything that I own. Well, dang, my cash is getting kind of low. I need to do something about that, don't I? That type of thing. I've got receivables of $3,100. Well, I could get my cash up if I could get those people to pay me, right? So that's what an accounts receivable is. Someone owes me money. So, I think it's time to go collect. What do y'all think? And that's what Mitchell would think if you handed this to him. Why do so many people owe me money? I was supposed to be a cash-only business. You following me? These things give tools for Mitchell or the business owner to analyze here, what do I have, what do I owe? You can see here, he owes someone $1,900. Where's he gonna find the specifics behind these numbers, though? How is he gonna know who he owes $1,900 to?
Your daily description of all,
Yep, potentially your daily description, but there could be 500 transactions
Your journal.
for accounts payable.
the journal,
No, you would go to the ledger. Because remember, the ledger is keeping track of, dollar balances. The journal is keeping track of individual activities that created the balances. Okay? But if we need to know specifically who owes us $1,900, we're probably gonna have to go to the general ledger and figure out, specifically who it was. That would come in, again, with a very specific set of books. So as you can see, it all eventually does come down to, formal financial statements that have headings, that have very specific orders that you prepare them in, and they tell us, all three of them told us different things, didn't they? The income statement told us he was profitable. The statement of owner's equity told us what he was worth. And the balance sheet told us he may be worth $7,250, but what is it comprised of? That's where we got down to the nitty-gritty of what specific assets and how much debt did he have to make him worth $7,250. So that's what Mitchell's concerned about. Mitchell is not typically going to be concerned about his general journal, his general ledger, but he is concerned about these. This is where he makes decisions from. Okay? So we are the accountant, we as the, quote, bookkeeper, are the ones that have kept track of and have records to back up every single number on these financial statements. That's our job, okay? And it's tedious at times. It can be very tedious and very detail-oriented. Okay, so let's kind of look at, I want to pull up some of your homework from Chapter 4 to kind of give you an idea of how this all kind of starts fitting together. I did post a video, if you haven't looked on Blackboard since last night about 8 o'clock. I had some technical difficulties this weekend. Our system was down. I did put a video out there on some Chapter 3 homework in case you were behind or didn't quite understand how that was working. Hopefully put up a video that will give you some explanation, and I will put another one up this afternoon on Chapter 4, just going over some of the random parts of homeworks that show up on mine. Y'all's probably are going to show up a little bit differently. You never know. But it should give you at least an indication of how to proceed. And I think there's still issues with the grade book, am I right? If you go to my grades, you're not seeing anything, is that? I mean, mine's always like this, but is this what y'all's looking on?
Mine wasn't showing like the specifics, but it was showing like the total of all of them. So.
Yeah. I can't seem to find anybody that can help me resolve that. I'm still working on it, but as long as you can see your total points, and then in Cengage is where you need to, be looking at your grade book, so to speak. Okay. So So I'm gonna go into chapter 4 homework. And we'll just, go through a couple of them, just so that, it's kind of making sense how we're going to, and some of these, especially through chapter 5, the homework gets a little bit longer and a little bit longer as you haven't figured that out. You know, they started off short and sweet, now more and more stuff is getting added to them. And so, kind of reviewing you again, this first little exercise that pops up, giving you a transaction and asking what account you needed to debit and what account you need to credit. And of course, we could have done that in T-form, couldn't we? But here's just kind of just testing your knowledge of the transaction, not necessarily a format. So if we pay office rent, for example, what two accounts are affected? What do you pay rent with? We've already talked about this last week a little bit. Cash. We pay rent with cash. So cash, though, in the grand scheme of things, of course, went down when we paid the cash to the landlord. Therefore, cash was credited, wasn't it? Because cash goes down by the rule of accounting for a business, cash goes down with credit. So I'm going to go over here to the credit column, and I'm going to find cash. It's not asking you for amounts to put in, just the account name. And the account that was debited, what did we do with the cash we paid? Rent. And what do we call that? What kind of an account name would we create for rent expense? So there it is. And of course, it's going to try to trip you up by putting all kinds of different accounts out there, trying to get you to bite on them. But this is where you have to know very specifically, for specific transactions, specific accounts are affected. Okay, so this is a great little practice one. Let's see, let's look at number 6. This one sometimes gives people a little bit of problem. We rendered services on account. That's a real fancy way of saying what?
Pay money for services? They have an account with you and they agree to pay you sometime in the future.
Right. So we went out and performed a service. Maybe Jane drove around some executive all day long in Lubbock, and by the end of the day she said, you know, now you owe me $300. And they said, well, I really need you to send that bill into the central office so that they can pay you. I don't deal with paying vendors, okay? And so she comes back to her books, and Jane does not want to forget that she drove around John Doe all day long, and John's company owes her $300. Agree? People forget, and that's another reason why we have accounting records. We don't want to forget who owes us. So that's the key here. Someone owes her money, doesn't she? She rendered the service, but someone has not paid her. So what kind of an account would we keep track of dollar figures from people that owe us money? What would we call that? Or what have we called that?
Accounts receivable.
Correct. And receivables are an asset, and her accounts receivable just went up, didn't it? So we would debit accounts receivable for the amount that, the $300, because someone now owes her more today than yesterday. Why do they owe her, though? What's the credit side of this?
Services.
Services. She performed services. We call that a revenue. And so we've, probably got some pre-established account that we were keeping track of her fair revenue. And then in this course, when you see the phrase fees, it's indicating a revenue of some kind. Fees for taxing people around, fees for preparing tax returns, fees for consulting, fees for whatever it is that you do. So we'll credit fees. Revenues go up on the credit side. On every one of these, you need to check your debits and credits. Does that fit what happened? What I just answered, did it fit? And if you're missing them, of course, it's going to tell you immediately. Figure out why. Don't just go back and try to fix it to make it correct. Why is that answer incorrect? So if I had put here owner's drawing for the debit, and cash for the credit. And of course, the grading system is gonna tell you that's wrong, but why is it wrong?
Those are conflicting.
Well, it's because when we pay rent, that's not an owner withdrawal, is it? Owner's withdrawal is when Jane or John or whoever takes money out and they use it for personal use, and it will describe that on the account. There's not one here, but it will tell you, owner withdrew money for personal use, or owner withdrew money in the amount of so-and-so. And when the owner withdraws, it's not for business expense. Okay, so let's go to the next one. Okay, this one they're wanting you to put in T accounts again, and then prepare a trial balance with separating it a little bit differently than what you might see in your book. But it's going to be, of course, by transaction, and we'll just do a couple of them here because I really want to get to a journal entry type problem. But let's see. Let's look at number 7. Now we're receiving cash from a customer that they owed us, and now they're paying us, okay? Which is what we want them to do, right? That's our ultimate goal. We may give you some credit and drive you around all day and let your company send me a check, but I fully expect to be paid, and my ultimate goal is waiting for that check, okay? So we received cash from a vendor, and they owed us $100, and they sent us $100. So what 2 accounts, always in your mind, you should be starting to think what 2 accounts are affected in this transaction. I received cash because, why?
I did services for them.
Right, from a previous bill probably, that they owed me. In other words, it's not saying that I received cash for an amount owed by a customer because I drove them around today. Maybe that doesn't make quite sense. In other words, what they're alluding you to is that this customer is already in your books as a what? Accounts receivable. Okay? First thing I want to do, though, is record the fact that I just put cash in my bank. Cash goes up with
So in this case, accounts receivable means, in this case, accounts receivable means you're receiving money from them.
Right. Well, in this case, it's saying that I have an accounts receivable on the records, and the customer is paying me, at least part of it. We don't know how much is totally in receivables just by looking at this.
Accounts I can receive money from, in other words.
Right. I have the opportunity to receive money from you because you owe me. And when you owe me, I call that an accounts receivable in my book. So cash went up, and by the rule of debits and credits, cash goes up on the debit side. So I'm gonna, sometimes where they do these, number 7, transaction number 7 would have increased cash $100. Okay? So that's what these little drop downs are here. It's just referring you to which transaction are you telling me you're going to debit or credit this account from. So it's transaction number 7. I have a debit to cash, but I can't stop there because I have to have a credit into another account. And we just said we're getting that cash because a customer owes us money, and that accounts receivable is an asset. Once they pay me that $100, do they still owe me that $100? No, not that specific 100. So we need to make the receivable go down, right? Accounts receivable is an asset, and assets go down on the credit side, right? So there's transaction number 7, and I'm going to credit cash for $100. Cash, accounts receivable. So I have a debit to cash, and I have a credit to accounts receivable. Okay? So you'll go through every transaction like this, and again, the main thing that you need to do is to make sure that you're analyzing every transaction properly, and that your rules of debits and credits are following what you're doing. Okay, so then you would do that, fill in all the T's, and then ultimately put your account to figure out how much cash, et cetera, to make sure your debits and credits equal. See if I can find one here that had a journal entry. Yeah, here's one. Okay, so these look very hairy, they look very complicated, but they're just giving you a whole bunch of information. And so this is for Diane, and she's opened a consulting business, and she has created a chart of accounts. And a chart of accounts is nothing more than a listing, typically with an account number, and that's for some reasons that we'll talk about in just a second, of what accounts are going to be affected in these upcoming transactions. So we need to create a cash account, office supplies, all these things, and it's just giving you this chart indicating to you these are the accounts that you're going to be using, and we have given them an account number, and you'll see why that's important here in just a second. Most businesses these days, especially small businesses that use QuickBooks, no one uses account numbers anymore because the computer doesn't remember by an account number, it remembers by a name. It's kind of weird how things have transpired. Okay, so here then they give you January 1st all the way down to the 29th, different transactions that happen chronologically in Diane's business. And of course, the first one you see is Diane put some money in her business. What do we know? What two accounts are affected? Equity and cash, assets. She put some assets into her business. So I'm going to go down here into my journal, and I'm going to record this transaction all by itself. And it just tells you this is page 1 of the journal, because remember, this is for a business that they may have 1,000 different journal pages by the end of the year. But these are going on page 1 because, of course, we just started Diane's business. So on January the 1st, we need to debit her cash, don't we? Because it just went up when she put that $12,000 into her business. So we're going to debit cash $12,000. Any questions on when an owner deposits money into their bank from the very first point in time? And then we just said her equity was involved. Well, her equity is going to be credited because equity or capital goes up on the credit side, doesn't it?
We never worry about where Kathy got that money though, do we?
Nope. For all we know, you know, she stole it. She stole some drugs. I don't know. But chances are she saved it. That's what we're...
And I guess another way of putting it, we don't worry about the credit of another account that it came from.
Right, we're only dealing with Diane's consulting business. What happened in Diane's? Where it came from is not our concern.
Okay.
Unless we're keeping both sets of books,
Yeah.
that would be handled in a whole different day. Who knows? So, okay, let's go to January 2nd. She paid some rent, $750. She had to have a place to work, so she paid the rent with what? Cash, and cash goes down when you pay rent, and cash goes down on the, what side? Credit side. So I'm going to go ahead and skip down. You know, there's no rhyme or reason that you have to start with the debit. You can go straight to the credit if you want to. That's what you get in your head first. So I'm going to go to my credit, and I'm going to find cash, and I'm going to credit it for, I think it said $750. But obviously, I need to fill in the debit. What did we just say she did with it? She paid, and of course it's going to give you choices, so that narrows it down a lot. She paid some rent, didn't she? So we're going to debit rent expense for $750. So there's another imbalance journal entry. This is one specific entry, January 1st, with another specific entry, but January 1st has nothing to do with January 2nd, does it? They are recorded independently of each other, but in the same location, in the same journal. Okay, let's find one. Let's see. let's go to the number on the 11th, January the 11th. Purchased office supplies on account for $250. So in your head, you should be thinking what two accounts have been affected. She bought what?
Office supplies.
Office supplies. And how did she buy them?
Account.
On account. And what would we call that? What kind of an account? Accounts payable. Because she owes
Account
them.
payable means you have the opportunity to pay someone.
Right. You're going to have the opportunity definitely to pay down the road.
And you could say that you just, well, even though you paid someone that amount of money, let's say, even though you could say you paid someone $750 for furniture, you also gained $750 worth in furniture.
Mhm.
That's why furniture will go on the debit side.
Right. It's like it's not giving me, there we go. Okay, so I'm gonna go down here, January the 11th. We already said office supplies were, was office supplies, right?
Office supplies will go on the debit side.
Office supplies on account, January 11th, $250. So, supplies went up, and supplies is an asset, so they're gonna go up on the debit side. Agreed? You gotta get this, it's just a routine, and you're gonna see the same transactions over and over and over again. You're eventually going to, once you do them enough, get it. But, we did not hand them cash, we put it on account, and specifically accounts payable, because that's a liability. We owe someone $250 for these supplies. So I'm gonna go find, accounts payable, first one. And I will credit that because accounts payable or liabilities go up on the credit side. Did we not increase our liabilities when we bought on credit? Yes. And on credit is just, again, one of those phrases that we, use in accounting that does not mean debit or credit. It's just it's a language to determine that we bought it without paying for it.
So we do not need to worry about, they bought it for 90 days, 0 down, whatever. Okay, so they have no equity into it. At this point, we don't need to worry about, well, after they have a portion of it paid for, that portion, now they do have a little equity in it.
Right.
Credit
And
card, credit, you buy something with a credit card, that means you're putting something on your tab.
Right. And I think you're only going to be messing with the whole brain process if you start trying to think about the equity portion
Okay.
involved.
That's the business person.
Right. The equity is a plug figure, okay?
Okay.
Equity is a assets minus liabilities. It's not anything up here that you can construe. Okay, so let me quickly, before we lose, Annabelle again, let's see.
I gotta get going.
Okay, you go ahead.
By next week, I'll have the first exam done.
Yeah. That's all right. Okay, so on the 15th, it says that we made a payment on this account. Made a payment on account. What do we pay when we decide that we're gonna start paying for these supplies that we just bought on credit? How are we gonna pay for them? With cash. So what day was that? That was, on the 15th, we pay $200 on account. So I'm gonna go down here to the 15th, and I know that cash just went down, and cash goes down on the credit side, correct? So I'm going to credit cash for $200, and I just said, we paid on account, didn't we? Accounts payable as a liability account, liabilities go down on the debit side. Isn't that convenient that that's what I need to
Mhm.
balance this journal entry? Growing up, and still to this day, I love working with jigsaw puzzles. And probably half of you in here have never worked one at all. But what do you think it is about accounting and jigsaw puzzles that,
The pieces have to fit in a specific way.
that's right. We have to have all the pieces fit together in a very specific way. And when I get finally down to that balance sheet like we did for Mitchell's delivery service, and all was perfectly in balance, and he knew exactly, that's like that final piece you put in that puzzle. Bam, it's perfect. Okay? So, obviously accounting fit my personality, and I didn't even know it. I just did it because I grew up in Amarillo, and my parents, of course, wanted me to go to West Texas, that's what then, or Amarillo College. I said, no, absolutely not. I'm not gonna live with you anymore. I was ready to leave, because everybody else was leaving, you know? So, my dad said, okay, you can, go to Lubbock, that's as far as you can go to Tech, and, but you have to major in accounting. And I was like, okay. I mean, that's literally was my response, okay. Suits me, as long as I get to go. And just thank the Lord it worked, you know, because I had no idea what the accounting was. I'd never had accounting in high school, never had even heard the word. But he was a business guy, and he said, that's what you're gonna do, because you will always have a job. And he has never been incorrect about that. I've always had a job, because what I'd say over and over again, every company has to have accounting. So, not many things in this world can you say that every business has to have this to be able to be successful. Okay, so once you enter all of your journal entries, then eventually you'll get to the part where you're going to be posting them to your T account. I don't know if it's in this particular problem. It probably is going to give you, there's Diane again, or am I just going backwards? Yeah, once you work through chapter 4, it's going to give you the opportunity to enter into a journal, post it to the T account, and then prepare a trial balance like you see here for TJ's paint service. And then from